All right. Well, here we are. I'm happy to start answering questions and engaging in conversation. Richard, nice to see you. Thanks for joining us today. And yeah, short notice following our LinkedIn discussion, but glad to have you here.
Yeah, man. Stoked to learn. Stoked to hear some
Yeah.
good stuff.
I'm stoked to learn as well. I always learn on these sessions too. Joshua, Andrew, Neil, thank you guys for being here. And yeah, looking forward to seeing where the discussion goes. So, Anush, I'm ready. We can begin anytime. I know you're doing double duty
Yeah.
here, so no pressure. But is Adam Reinhart joining, or does he? I know sometimes he's in and sometimes he's not.
Yeah. Not sure. I think he said he might be joining. He might
Okay.
drop in a bit. I know there was some confusion with like the timings and everything. I was totally confused by Adam's message in the group.
Yes, I still don't know what that meant.
Yeah, yeah. So I was like, okay, let me quickly let me quickly change up everything.
Yeah.
Okay, so we got a few people in. Andrew, Joshua, Neil. I think people are just kind of hopping in. But yeah, Richard, I kind of already gave you the rundown. Ask Ben the questions, the burning questions you have. Drop them into chat here, or I mean, if you would like to ask them anonymously, you can drop it into the Q&A under meeting tools. And Joshua and Andrew, Neil, you guys know the drill. So let's fire up the questions. And I guess as we wait for some of the questions to hop in, Ben, I can get you started with one that I have for you.
Sure, that sounds good. And Anush, I think what would be helpful. So last week we had a couple of people that at one time or another, and this wasn't a significant issue, but as people would unmute themselves and
Yeah,
start
yeah,
talking, like that would they would there were a couple who were kind of dominating the conversation.
yeah.
And so with a smaller group like this, I am a little bit less concerned about that. And
Mhm.
so but I'll leave it to you, Anush, as the moderator to decide kind of whether we at one moment or another whether we allow direct verbal follow up
Right.
or whether it needs to be done through chat.
Okay. Sounds good. Yeah, I think we can just kind of see, take it case by case. If maybe somebody is asking a question and they need to explain and give you a little bit more context, then maybe they can hop on for a little thing.
Whatever works for you works for me.
Okay. Ben,
Yes.
so my first question for you, and this is something that is very closely related to what I'm struggling with right now.
Yes.
What do founders most often get wrong about pricing in their first couple of years?
That's a great question. um I think the what do they most often get wrong about pricing in their first couple of years? There's I Anush, it's obvious they either price too high or they price too low. um, but to be more specific, I think what is most valuable in the pricing conversation, really what you want is data, right? Hey, what you want to know whether you're pricing too high or too low. And so what I think founders should do in an ideal world is
Mhm.
do more dynamic pricing. And what I mean by that is not dynamic pricing in the sense that it's often used in 2026 where you have something that automatically adjusts your pricing by like
Right.
typically time of day or day of the week or stuff like that, like from a temporal perspective. What I'm thinking of when I say dynamic pricing here, what I'm actually talking about is doing A/B testing on different
Mhm.
types of on different pricing methods, on
Right.
different pricing approaches. I think it's really good for most founders, if available, to adopt some kind of freemium model,
Mhm.
so they can get the opt-ins, work that top of funnel, but also to be pushing something toward conversions.
Right.
I think especially, I mean, and there's some verticals where that's just not relevant because the
Mhm.
the the opex is so high that
Right.
a free offering just doesn't make sense. The
Mhm.
unit opex that I mean is so high
Yeah.
that a free offering can't work. But in software, I think every software should be a freemium offering of some kind. So, and I mean, there are probably limits to that, but really, you want to be doing A/B testing. You want to be, trying a bunch of different stuff, and that's easy for me to say because it's yet another thing on the menu of stuff that founders could or could not be doing. And if you're doing this, you're not doing that. If you're not doing that, you're not doing the other thing. If you're doing that, you're not doing the other thing. It's operations, it's product, it's sales, it's fundraising. The founder can't be right in terms of how they're spending their time. And I feel that. I feel that very deeply. Having said that, in an ideal world, I think this is the correct approach to pricing, is doing it in such a way that you can actually get actionable data on when people buy. Because the right price is, in all else equal, which it typically is not, but all else equal, the right price is the profit maximizing price, right? It is the price at which you lose, the number of people who buy times the profit that you make per each one is where you want that to be the highest it can be, right? And so, that's a curve, obviously, and you're looking to find it's one of the tangents of that curve. But yeah, so it's usually not, calculating that is usually not a simple thing. It's not trivial or straightforward. So yeah, but I do think that experimenting with different types of pricing models as much as possible in the early going is the right way to think about pricing.
Okay, thank you so much, man. Okay, Richard's got a question for you next. So Richard says, we're building SMS follow-up software for churches, help staff follow up with first-time visitors without learning a new app. They're mid-raise, faith-aligned round.
Okay.
What would make you personally pass on a deal in this space without even looking at the deck?
That is a great question, Richard. Really good question. And you've phrased that. I honestly, Anush, we need to, Richard, we're going to steal this wording, because that is such a visceral question for an investor, and it's wording that I haven't thought to use before. This is really, really insightful, Richard. Great, man. This round of applause for this one. It's also particularly relevant in this space, and I think you might know the type of answer that I think you might have a correct instinct in terms of where I'm going to go with this answer. In this particular space, where you have to be really cautious is in seeming like no, it's not TAM. It's a version of that, but it's really about seeming like you're profiteering in the church space is a very delicate thing. And so honestly, for products and services that are serving churches, man, and I say that like I am the senior warden at my Episcopal church. I served on the vestry for the last 3 years. Our priest was sitting in that chair 3 days ago talking about long-term vision for I go to an Episcopal church locally. So I'm a senior lay leader in our church. This is a very close issue to my heart. I'm very active in the faith-oriented investor community. And the push and pull with something like this is if you do things right, there is a lot of money to be made in churches. And I don't want to be but I want to be very careful about making, I want to balance the making of that money with simply serving the best interest of the church in question or the churches in question. So what would make me pass on a deal is I would actually probably be more willing to write a check of the same size to a nonprofit in the church space than I would to invest in a company that, like, You know what? Actually, let me revise my answer a little bit. Exit strategy. I think it's all about what is the end game for this company. Is it planning to, once it reaches a certain size or a certain point of profit, is it planning to return some of that profit to the churches? Like, I it's so tricky navigating the balance between community good and money in churches, and some churches have a crap ton of money, but I would want to be very careful about about benefiting financially from that. And I would consider both corporate structure and exit strategy. And exit strategy is not the right word. It's really more about end game, because I think that many Christian investors, myself included, and religious investors more writ more large. But in the United States, I think churches, Christian churches specifically, are the place to, are the sort of the patient zero of that process, so to speak. And so I would look at, like, is the company looking to get $1 billion exit? Like, this is one of those situations where I would actually be less likely to invest in that. So, like, like it would be, what is, in almost any other industry other than like Vice or something, or maybe gambling, which I guess is a kind of a vice. This is kind of the maybe the opposite problem, where the mission is so important that I would want to, like, I would consider carefully how you balance, here is all the money that we can make versus here is the good of the community that we're trying to serve. I guess that's the simplest way I can put the answer. Okay. Yeah. And yeah, knowing that the founder actually cares, and is in it for the good of the community. Maybe if you donate a certain portion of profits to, a nonprofit that serves churches, that would be a big step. Um, I think that would be a big thing. And then if you still are, like, if the goal is still to get acquired, but you're apportioning a certain portion of the profits and intend to do so after the acquisition, that would probably go a long way for me. Anush, what's next?
Next, I guess we're still waiting for some more questions from the people in the group, but I got one for you.
Yes.
What's one piece of advice you give almost every founder you mentor that they almost always resist at first?
Well, the first thing I'll say is not something that they necessarily always resist at first. Well, okay. From a 30,000 foot perspective, the most common recurring piece of evidence that I think makes founders leave because they want to disagree with it is, you're not as ready as you think you are. I think so many founders are convinced that if I could just find the right investor, that I will get my $1 million check. And I talk with founders all the time. I had a LinkedIn conversation with one this morning, and they keep wanting to, like, subvert. Like, I tell them, hey, send the deck to this email. My team will go over it. We'll make recommendations. And they keep wanting to come back to me and saying, no, what did you think? Will you take a meeting with me? And the answer is, no. No, you are not ready to meet with somebody. Like, and it's not about me. I'm not trying to give myself airs or have delusions of grandeur here. It's just, there's an enormous amount of demand for the time of somebody in my position. And if you are not ready to crush it in your pitch, don't take a meeting with somebody like me. And I think there's so many founders that as soon as they hear that, they're like, no, I really would rather find dumb money. And dumb money just doesn't really exist anymore. The world is so connected, and dumb money has already had its lunch eaten. There is no there. It's arbitrage, basically. You might once in a blue moon stumble across an arbitrage, like a legitimate arbitrage opportunity, and you might once in a blue moon stumble across some dumb money that hasn't had its lunch eaten yet. But don't plan your fundraising strategy around that. The goal should be to continuously be getting better and making yourself the best you can be so that you can sell to smart money. And so the other thing, and I gave this feedback to a cohort at Generator earlier this week, was I am not seeing valuations or valuation caps for safe notes on pitch decks. People are saying we're raising 500K and here's how we're going to use it. That's all correct, but there's no valuation and there's no valuation cap. The terms of the safe note are often not on the deck. And so I said to the MD, they need to put the valuation on there, or if it's a safe note, they need to specify a valuation cap. And I think some founders are not doing that on purpose, because they want to maybe let the lead in. Maybe they're trying to say, well, you go first. What do you think this is worth? Or maybe some other thing like that. And as an investor, my response is, yeah, I don't have to do that. You tell me what you think it's worth. And if you don't want to, then come back in 2 months when you're ready to give me a valuation. Like I'm sorry, but you're not going to force me into a position where I'm going to value your company for you. And if I'm going to value it, I'll value it at $500,000. Do you want the check now or later? But don't play those games. If they are playing a game, don't play games with me as an investor. It's your job to say what you think it's worth, and then I'll tell you if I disagree. But and if they're just not doing it because they haven't thought of doing it, please put your valuation or valuation cap on your pitch deck.
Awesome, thank you, Ben.
Mm-hmm.
Richard's got another question for you.
Yes.
At pre-seed with little to no revenue, what's the single move that actually gets serious investors' attention?
Other forms of traction. It's what do LOIs look like? Like, can you get a church to say, hey, I would buy this if? Can you get do you have and the best version of it is obviously pre-sales. If you said, we could solve this problem, will you put down $100 deposit on the idea of purchasing the software, or a $50 deposit, or a $10 deposit? When you've taken on revenue, any kind of revenue, $1 of revenue, your valuation 1.5 to 3x's overnight. And I mean that in a very literal sense. Like the valuation that I would invest on for a product that exact same product with $0 of revenue versus literally $1 of revenue that did not come from friends or family, overnight, 1.5 to 3x valuation. But if you can't make the pre-sales, there's it's LOIs, it's free users, it's social media following of the company, social media following of the founder, engagement. It is even market surveying. What do people say? And not, do you think this is a good idea? Would you buy this? But market surveying that's motivated by the processes in a real customer discovery system, like the one that's laid out in The Mom Test by Rob Fitzpatrick. That's a great book. Only really good book I've read on customer discovery and market development is The Mom Test by Rob Fitzpatrick. And we can drop that in chat if anybody's interested in going and picking that up. But so if you say, hey, if you go and ask people, hey, do you think this is a good idea? Would you buy this? They'll all say yes, and it doesn't mean anything. But if you do real market discovery, real customer discovery, that actually means something. And I would look at that as an investor and say, this founder is serious. Most importantly, what I need to know as an investor is that you, the founder, are not waiting for me to save you. And so often what I see in pre-seed raises is the founder who says, I can't do anything until you give me a lot of money. I want no part of those founders. And I say that with all the love for the difficulty of the founder's journey. But the founder I do not want another conversation with until they can get their crap together is the founder who says, I know there's no answer. Without money, I can't do anything. Sorry. I want the founder who will turn nothing into something. And because that founder, when I write them a big check, it's actual rocket fuel. For the founders who are just waiting for me to save them, what's on the other side of a big check is just more effing excuses. And I have no patience for that. I want people who are self-deterministic. And so demonstrating that by continuing to show all these other forms of traction pre-revenue is what makes me more likely to invest pre-revenue myself. And my experience is usually that those founders will actually back into revenue at some point, and then they're off to the races with or without me. And don't ever say that to an investor. Don't ever say this is happening with or without you, but you want to demonstrate that in your actions and your progress.
Thank you, Ben. Richard's got another question for you.
Yes.
He's saying, if you were me, first-time founder, faith niche, pre-seed, would you spend energy trying to get into rooms with secular VCs or stay fully in the faith-aligned ecosystem for this round?
I would talk to every investor that you can. And you know, once you've got a term sheet from somebody, or once you've got serious interest from somebody, then I would ask myself, all right, what lane am I? What lane is this actually the right lane to be in? I would not necessarily take the first term sheet that somebody offers you in this situation only, where you're trying to determine, all right, it's actually really important. Do I want to be here, or do I want to be here, or both? But for the time being, you want every founder wants to talk to more investors and should be talking to more investors. The more investors you can have conversations with, and the way that I would frame it, and I think, I don't recall every detail of our conversation, Richard, but classic proverb, and Austin quoted this to me a couple of weeks ago: ask for money, get advice; ask for advice, get money. I put it on the advertisement for office hours last week. The founder of Startup Junkie said the same thing. Jeff Amorine, I don't know how he pronounces his last name, but he said the same thing like 3 days later, and it keeps ringing in my head. The investor who believes you truly, because asking for advice is a signal for wanting to improve yourself, and asking for money is not necessarily a signal for wanting to be rescued, but it could be. I see. I don't want to go out of order here, but I actually have a deck that I built entirely around other forms of traction pre-revenue. So let's not skip ahead, but when we get to that, I'm going to screen share this deck. Go ahead, Anush. Whatever's next.
I think we are there because the rest of them are just like conversations. So yeah, Gat's question is, what are the forms of traction pre-revenue?
Yeah, let me pull it up. So we'll get into Anush, I'm not allowed to share my screen. Do I need to send the link to you?
Oh yeah, I think Sir Adam made the restrictions quite tight on this.
Okay.
Yeah, go ahead, send the link to me. I can share it and then.
Yep. Okay. Add people. What email should I send it to, Anush?
If you just send it to admin at TFG, I can access that.
Admin at thefounders.group?
Yeah.
Okay. And comments. Share. All right, that should be in your inbox. Meantime, let's skip ahead to next questions, or if there aren't any further questions, then we can wait for that. But I want to make sure we're just using every minute we can.
I don't see any further questions, but here, let me just open this up real quick. Just a moment. Okay. So let me share that. Just let me know as you would like me to go through it, Ben.
Sure. So yeah, so startup traction, and I did a presentation on this. There's a YouTube presentation that I did, and I'll look for a link to that as well. But so yeah, proving your market value. Let's go to next slide, Anush. Yeah, you guys probably know all of this. It is the single biggest determination in what the valuation actually is. Now it's not necessarily the biggest determining factor in whether the investor plans to invest or not, but in terms of in terms of setting, all right, what is a reasonable valuation that then determines that in part shapes the investor's willingness based on um, based on whether you're above or below or right at that valuation. um, is so traction is the single biggest determining factor. So next slide. Right. Okay. So this is, and I'm not breaking news here. The biggest ones are going to be recurring. The biggest signals of traction are going to be recurring revenue. That is the safest stuff. ARR, MRR, key indicators of sustainable growth, especially if it's broadly diversified, diversification of revenue. If you've got one customer that is your entire, that's your entire ARR structure, investors are a little bit twitchier about that. But if you have well diversified recurring revenue, that's the safest thing there is. That's the thing people are most likely to invest in if the numbers are equal. Non-recurring revenue, also great. So next slide. Now we're assuming that we don't have recurring revenue, that we don't necessarily have ongoing sales, but pre-sales with payment, even small deposits, that is way better than nothing. It's better than nothing at a level that I think many founders don't fully understand. And they think, well, why would I bother going to make a pre-sale for $100? That just doesn't make any difference. It does with the investors. Because what you can do is you can say, if I could make one pre-sale for $10,000 or 50 pre-sales for $100 each deposit on a $10,000 purchase, I would much rather see 50 pre-sales for $100 each, even though the revenue is half of what it is in the other scenario. Because again, you've got the customer diversification. And you've got people who made a financial commitment to make a much higher amount of purchases once the product is available. So the implicit revenue there is much higher. Yeah, and Lou commented, I got someone to pay their hard-earned American dollars, even for a church, their dollars that they are responsible for stewarding, is much better than I think I can get someone to pay their money. And by the way, investors are well aware, we touched on this a few minutes ago, of the challenge of and yeah, everyone said they're going to buy it. They're lying to you. Everyone with the best of intentions, with no nefarious intentions, is lying and saying, "Yeah, I want to support my friend. I wish that I would pay for this. I want to pay for this, but I don't actually have any intention of buying it." The other thing is, as humans, we are very bad at knowing what we would pay for in the future. So someone might think, "Yeah, I would buy that. I would absolutely buy that." And then when the time comes for them to actually click the button, to actually sign the check, to actually put their hard-earned or well-stewarded American dollars. I mean, no disrespect to the founders outside the U.S., but I'm just like the personalization of this matters a great deal. And for for a United States buyer, a United States investor, their hard-earned dollars, they're going to put those into the pot. Their hard-earned dollars that somebody else donated and that they're responsible for shepherding. It is a totally different conversation. So once it comes time to actually do that, rather than to talk about doing it in the future. So pre-sales with payment. Next. So there's not a title for this one, but signed contracts and committed pilot customers, whether they've put down like a signed letter of intent. A pilot, even if it's not paying, that's data. That's valuable information because they're using the product. And especially if there's a freemium offering, those people are more likely give you their hard-earned American dollars in the future than someone who's not on a pilot yet. Next slide. All right, now here's where we start to get away from the actual people are using this. So you've got a wait list. People are saying, hey, I'm interested in knowing when this becomes available. Patents are proprietary, and this is not as relevant in software because patents in software don't really exist for the most part. But proprietary patents create a defensible market position. That's it's going to be more true in deep tech, hardware, robotics, space, things like that. And then a proprietary network. So this is how Amazon at one point was the largest company in the world. They had a distribution network that nobody could duplicate. And they had spent 2 decades building that distribution network, and they had this unassailable moat in the retail space, and they're still, I think, considered the world's premier retailer. I know Alibaba's in the game and Temu's in the game, and there are other retailers that are trying to attack Amazon. Everybody still acknowledges Amazon as the gold standard, and the reason is proprietary network. So in your case, Richard, using your network around the church system, and I think you asked a question about this, but that is. That it is an asset. Is it the best asset? We'll talk about that. But it is a significant asset. Next slide, and we'll kind of zoom through the rest of this so we can get back to the questions, because I see a bunch of questions are rolling in. Unqualified wait list, general interest signals. This is sort of your market surveying, I think. Next slide. Engaged community, engagement with the founder, engagement with the company. If you have your own Discord server, if you have your own Slack workspace, if you have your own subreddit, that kind of thing is, just saying. There's a company that I'm still considering investing in called Captain Side. Then the biggest thing they have going for them is a subreddit with thousands and thousands of members that I found organically. Because it's around video games, and I love gaming. So that one's a big deal, is having your own community that adds value for its members, and that your company or your content is at the center of. Go ahead, next slide. Yep. Distribution partnerships, pre-launch ad performance. And Anush, you're welcome to share this deck if you're able to share it. You're welcome to share viewership to anyone who wants to look at it. This could go on a billboard in Times Square. I'm not protective of this information. Everybody should have this. So I'm trying to find the other video that we did pre-revenue traction 10 months ago. Here's the video. I will drop this in chat as well. So, because this question gets asked all the time, pre-revenue traction. And I did a presentation similar to this one. We used a slightly different deck, but I don't have access to that deck anymore. So it's basically the same stuff, though. All right, let's get back to the questions, and I can go till 12:30 today.
Awesome. Okay, let me just end that, and I will share the link if I can figure out how to share it so that you don't have to send it out yourself.
Let me see if I can drop the link openly. Public view link. Here we go. Create public view link. Copy and drop. Somebody let me know in chat if you guys cannot look at that, because this is for everyone. Everyone should be able to look at this. Anush, next question,
yes,
please.
Sir. Okay. So next question comes from Richard again.
Yes.
Richard says, my credibility is 16 years as a pastor living this problem, not a Stanford pedigree or a prior exit. How much does domain expertise actually compensate for those missing signals at pre-seed?
A huge amount. Deep domain expertise is in some circles is better than now. Not every investor feels that way. I personally, full disclosure, I'm not one of the investors who feels that way. I would rather have my favorite thing is prior exits, a founder who's taken a company all the way through before. Having said that, deep domain expertise is a whole hell of a lot better than nothing. Stanford, Stanford degree, like, Amazon experience, that stuff also matters. To me, that's actually third on the list. Like I was 6 years at Google or whatever. Like that's third for me. And the education and the big brand associations, those I consider those kind of tied for third on my list. But so Richard, I think the deep domain expertise and I actually, I know a VC who does first dollar checks. Let me find. I'm gonna get you an investor connection right here, right now. What is the name of the? I think it's Daring Ventures. Yes, Maddie Holman at Daring Ventures. Reach out to me about an intro to Maddie Holman. Because what they look for is buyer builders. Now, I don't know if they'll be interested in this market, but they specifically are looking for builders who are building out of their own prior pain points. So some investors really value the deep domain expertise more than anything. Here is an example. I'm looking at her LinkedIn right now, but not every investor values them more. Maddie Holman, Daring Ventures. All right, Anush, next question.
Yes, sir. Next question from Lou. He's asking, what's a good litmus test to find if an avenue or investor is BS, for the lack of a better word? Because there certainly are BS. Sorry, it's going on.
Yeah, go ahead.
There certainly are BS founders, but there are a lot of snakes dressed up as your friends as well. What's a good way to weed that sort of thing out?
Yes, that is a good question. And there's a very fine balance here, because I think that a lot of I really think yeah. So Austin's asking a follow-up question. Is this referring to who has money to deploy, or literal fake investors? There are so myself, like I write investment checks. I'm announce them on LinkedIn all the time. Make investment announcement all the time. I also do advisory work, and depending on what stage the company is in, sometimes the level of contribution on the advisory side is not compensatable with just equity. Like there's often, if we're doing investor relations newsletters regularly, if we're doing weekly LinkedIn content for somebody, that there's often a retainer associated with that. And some investors will say, and some ecosystem partners will say, as soon as somebody asks you to write a check, they are fake and do not do any business with them. That's just flat incorrect. And so, but unfortunately, that makes this question harder, because it makes it harder to tell. All right, there's not a simple heuristic. And so, what I would say is look at social proof. And that's why, like on LinkedIn, I really try to make a big deal of, look, like I'm also writing money back into the ecosystem. I'm making capital outlays all the time, and you can ask for references. I don't think that's unfair at all. You said if there's not a ton of evidence available on LinkedIn, is probably the best place to go get it. And if it's not there, I would say I would love to talk with others that you've worked with, other people that you've invested in. I would love to connect with some of your other portcos. And if they say, well, why do you want that? I think it's perfectly fair to say, I'm just trying to. You can't be too careful. I'm open to I'm open to working with anybody, provided that there is, provided that there's a record of performance, essentially. So I remember I remember Charlie and the Chocolate Factory some. I don't remember what Slugworth's actually like. Was he like Steal the Everlasting Gobstopper or something?
Yeah. So what I'm asking about is people who seem to have sort of their own, either their own product interest or their own like tech research interest in mind, and they'll say, hey, we'll invest X amount if you change the product in this way, or if you go deeper this way with the and that's great. I'd love for you to write me a check, but I'm not gonna compromise my stuff and then also do work for your product for like free. I don't get.
Yeah, that's a perfectly reasonable position for you to take, Lou. I would say, so I would not go so far as to call that a scam. Like I would say that, whereas now Slugworth's thing, that actually was some like some sort of criminal thing.
He wanted him to steal it.
Right, exactly. And so I would say the best acid test I can probably give you is if you're holding aside the investment dollars, if you're holding aside the exchange of money, does the action otherwise, then without the money attached to it, does the action seem ethical? And for them to ask you to do it is perfectly reasonable, and for you to say no to doing it is also perfectly reasonable. So I think that's important. I think that distinction is important, because there's a big difference between somebody's asking for something that is maybe not very palatable to you as a founder, and perfectly reasonable for you to take that position, by the way. Right. But it's not, I wouldn't put that person on LinkedIn and say, hey, watch out for this guy. Because there may be founders out there that would say, I would love to have an arrangement like that. And then some founders that won't. So it's very much a continuum, a fade in terms of like, well, this person over here is an outright fraudster. This person over here is the sort of the utopia of exactly what you want from the investor. And then there's a sea of gray in between. The only person that I ever actually considered putting on blast was the person who said, basically, the way you can fund your company is to write a bunch of like credit card requests all at the same time, so that the credit checks all fall at once and they haven't gone on your record yet. And basically you can subvert the credit reporting process in that way, which sounds a lot to me like fraud. I thought about blacking out the information and reposting, and basically posting a screen grab and saying, anybody who does business with this person, I'm not doing business with. Because that if you see anybody who talks about doing that, do not do that. That is, I'm not an attorney, but that sure sounds a lot like fraud to me. Don't do that. Everybody else that I've seen on LinkedIn is typically like kind of somewhere in that sea of gray. There's very few people that I'm saying, hey, just don't do business with this person. I don't like what they're advertising. And I think there are a lot of people who get up in arms about sort of the investor brokers and all of that. My deal is don't break the law, and do things that are broadly ethical. But there's a lot of different ways of kind of making your way in the investor founder space. So hopefully that answers the question.
I really hope that's not one of the advice that founders resist at first, but don't break the law.
There's a specific situation with it, and I'll talk to Adam or Anush and you like later privately about it. But yeah, it just kind of rubs me the wrong way when someone is like, yeah, we'll get behind this, but only if you do our product that for some reason didn't work also with yours. And it's like, oh, okay.
Yeah, and there is an accelerator out there, and I'm not going to name names on this one, but their deal is kind of one of the darker shades of gray, in my opinion. They're a non-investing accelerator, and they invest a small amount of money, which then is all spent on their software. and it's not really an accelerator. It's really a funnel for software. And I think that's a little misleading to call it an accelerator, because there's sort of this understanding about what accelerator actually means, rather than as a tool to just help you sell this software. And I'm not going to name any names because I don't want beef with anybody, and I definitely don't want to get sued. But ask some questions about what the money has to be spent on, or if there's a requirement for what the money should be spent on, if you are dealing with an investing accelerator that writes pretty small checks. Next question.
Yes, sir. So next question is from Andrew. He's asking, should a founder spend his time gaining clients or getting fundraising? Does that change depending on the stage of the company?
Sales are always better than fundraising, always, because it's non-dilutive. $1 of sales is always. I want to be careful about the word always. I can't think of a scenario where sales is not better than fundraising. Not even equal, better, because it's non-dilutive. It's all sales are non-dilutive. So if you, and I mean, you could say, all right, this client is going to be more challenging than this investor, like that. You're introducing kind of a not all else is not equal in that scenario. But sales are always better than investment dollars. Now, having said that, there are some situations like really high capex stuff where you just can't. It's really hard to go get the sales without or even the pre-sales without the investment dollars. So I certainly understand that. In software specifically, if you can't get an MVP to market in 2026 with AI, then you need to be in the founders group, because we've got developers everywhere. And if you can find a developer co-founder without having to involve an investor, and we can vouch for your company and say, hey, you developer A should talk to company B. We consider that to be an investable project, and you should consider working for that company for equity, or joining up for equity. We broker deals like that all the time. It's a big part of what we do at the Founders Group. And so, like, my response, especially to a software founder saying, I cannot get to market without investment dollars, is, are you doing quantum compute? Because otherwise I don't believe you. Like, there are developers out there who can do this, and we can help you connect with them. So that is how I feel, and that's software only. Other stuff, heavier capex, like that's a different thing. But next question.
Next question is from Richard, and maybe this kind of got answered a little bit already by you, Ben. He's asking, if you had no warm network in VC and were raising faith aligned, where would you spend the first 30 days?
In the founders group, honest answer. I would, and come pitch to me, come pitch to us. Keep coming back to office hours. We've got a bunch of folks with VC connections right here in in office hours. Join the leader team. Like, we've got serious investors floating around every single week at leader meetings, 11 o'clock on Wednesdays Central Time. So that, like, I would hang out a lot around the founders group. And I mean, yeah, it's our community. It's, I guess, my community. But yeah, there's investors everywhere. There's ecosystem partners everywhere. There's every kind of asset you can imagine. So biased answer, but I genuinely believe a true answer. And there's a reason it's grown from literal zero to, nearly 600 members across founders, investors, ecosystem partners, executives, in 381 days, I think, if my math is right. May 2nd was the day of the first Reddit post that blew up and launched this whole thing, just over a year ago. The actual Discord community turned a year yesterday. So big value add, in my opinion. Next question.
I think scrolling down, Lou, you were asking questions about Were you asking about the 250K pre 5 million? Okay. So Lou's asking 250K pre money. Oh no, 200 pre-seed 5 million post valuation on safe. Decent numbers for AI hardware.
AI, what is, and we
I'm
might
talking
have
about for
spoken a
Candid,
little bit.
basically. Yeah.
What's that?
Talking about for Candid, basically, like something like Candid, where, you know, a smaller amount like 50K would get me in the door, but like in order to be at scale, which is where, like on the deck, when you're talking to investors, you're trying to show them the numbers at scale, right?
Sure.
So, but like, what's the line between what's like realistic to say that is those numbers, and then like versus the 50K that I need to get operational, and then when I'm talking to investors,
get operational.
Yeah.
That now that's my answer. Other investors may disagree, but as an investor, if you're pre-revenue, I want to know what is the smallest possible risk I can take to make sure you're not the come and rescue me founder. And I don't mean you, Lou, but I mean just as a general rule, if a founder's coming in, like I want to know what gets you to MVP, and give yourself some contingency, like, you know, add plus 20%, but not plus 400%, to just get you in the market and get you to a spot where you can make sales, so we don't have to be having the conversation about here's what's between me and my first sale.
And that's why I have that 50K on the slide. But do you think even I should drop it down? Because I mean, like, gun to my head, I could probably do it with 20, but you know, I want to be realistic. You know, I want to say I will probably end up needing X amount.
Yeah.
And if I have X amount, then we can get to, you know, these levels.
Yeah. What I would do is, yeah, I and it's challenging because going to there's a little bit of a push and pull here once you get to a number like, you know, 50K or 20K. There you'll need to, for that, and I realize I'm giving you advice that's a little bit contradictory here.
That's okay.
But I as the investor would be much more likely to do matching funds toward like a 50K check to get something into market than I would be to write a check pre-revenue toward a 250K raise. And so what I might say, and I'm not formally offering this, but what I might say in a situation like that is, if you can raise the first 25K from friends and family, I'll write the other 25K. That I would, and it's basically a challenge to the founder to say, again, like to say, all right, I understand you're trying to not bootstrap this, but you're really trying to go after MVP, and I respect that. But you got to go find the first 25K from friends, family, and mattresses.
You know, it's funny that that's such a challenge, because you know, as far as friends and family, there's really only like a couple people that are even like in the considering that would be able to fund something like that.
That's typically true.
And I was talking to him yesterday, and he said almost the exact same thing, but the other way. He was like, yeah, it looks great. I would love to be on it. He's like, when somebody jumps on it and writes you a check, let me know, and I'll match it. And I'm like, okay, well, bro, they want to see it from you first. That's like, okay.
That happened. That would happen all the time in the movie business. There were funds specifically that would say, we will never write the first check. We will always write the last check. Go get the first half, and we'll finish you out. And it makes the due diligence a lot easier, because they know somebody's got to do DD on the first half. That, and I don't typically take that approach of saying I have to be last money in, but that's something that I would probably impose. An investor who's looking to follow a lead, follow investors. But that is a common stance, because there's just a lot less risk of in doing fill than there is in taking a lead position. And the benefit of being the lead, of course, is you typically get to set the terms. That's why VC, you're more likely to see a VC in a lead position. There will be follow VCs and there are lead angels. It does go both ways, but more commonly you'll see a VC firm that has a very built due diligence process taking a lead position. And for a 250K raise, you're not gonna involve VC in a raise that size usually, but unless they want the whole round. But yeah. Angel list. I think I've heard good and bad about Angel list. I don't have a very strong opinion about it. My experience is that big brands like that in the investment space are often very Bay Area and New York centric, very coastal. And I do more investing around, middle America, between the coasts. I invest in Silicon Valley stuff and I invest in Boston stuff. I'm connected with a couple of angels in New York. Florida is not exactly the same thing, but I've got some ties there, and then a bunch of ties in Los Angeles from my movie days. Yeah. So I don't have a strong opinion one way or the other. I heard somebody crapping on Angel List the other day, but I've also heard people say good things about it. So I apologize that I don't have a more informed opinion on that one.
That's okay.
Next one, Anush. And I might be able to stay even a couple of minutes over, but let's cut the questions here, but answer everything that's been asked so far.
I think that was the last question.
Okay.
We don't have any more. Yeah.
All right. Well, thank you, everyone. Really appreciate all of you for being here. Thank you for asking the questions. And Anush, we'll work. So for everybody that's here today, Anush, what structure are we going to use to get everybody a link for next week if they would like to join next week?
So what we can do is we will post the same the Google Forms link in the Discord, and then somehow maybe on your LinkedIn you might have to make a post again.
Okay.
Or maybe from the TFG side we can make a post.
Do they need to register again for next week?
If they're not coming in from TFG, because TFG we can just share the link in the Discord.
Would you drop a link to the Google form on the chat, Anush, before we step away?
Yes, absolutely.
Thank you.
Let me just. There we go. Yeah. So this would be mainly for people coming in from the socials. For people that are already in TFG, which I think most everyone in this call is.
I didn't even get my flare, dude. I didn't even get my leader flare, man.
Lou, I'll go ahead and upgrade you. I'm still finalizing the code of conduct. We got to get everybody to sign. But yeah, okay, there we go.
Where's Sir Adam? Is he ill today? What's going on?
That I do not know. I think he might be at work.
Oh. I was going back and forth with him about Discord stuff last night.
Yeah. All right, Lou. All right, I'm gonna go ahead and give you the leader role.
Appreciate you.
Yeah. And then we do have to get that code of conduct out pretty soon, but don't worry about it for now. All right, now. Okay, so this happened with Lee the other day. He didn't pop up. Okay, I can tag you on the leader channel already, so you should be able to see everything now.
Mm-hmm. Yeah, I've got it.
Okay. Anything else? Anything else for the good of the order? You guys have the so jump on the Google form. And Anush, is that registration for next week or this week, or just making sure if it's the same link, does it give them access for next week?
Yes.
Okay.
It's just a general kind of registration link, and then once I have that information, I can email them out the meeting link off of that.
Yeah, no, happy to be helpful with this, and thanks for thanks everybody for buying in on this format. Next week, Ichan will be doing office hours for me, and I think the time may have shifted slightly because he's doing it. Because I'm going to be coming back from Toronto for a Creative Destruction Lab super session. So yeah, Gab, the form is, we'd love to have TFG members do the form, but you can also access the link. You don't technically have to do the form in order to access the link. For non-TFG members, we just have to get the registration in order to get them access to the link. And that's, yeah. So you can get in without it if you're a TFG member.
Yeah.
Okay, thanks everybody. I got to jump, but thank you so much for coming. Thanks for your questions, and have a great day.
Thank you so much for your time, Ben. Appreciate it.